Most trading accounts don't die instantly. They die slowly, quietly, one bad habit at a time. And the dangerous part, the thing destroying most traders, doesn't look dangerous at first. In fact, it often feels completely normal. The wrong assumption. Most traders think accounts blow up because of one huge mistake, a massive loss, a terrible setup, a market crash. But usually, that's not what happens. The real damage comes from smaller decisions, repeated consistently, and over time, those decisions become deadly. The silent killer revealed. So what is the silent killer of every trading account? Emotional decision-making. Not lack of intelligence, not lack of strategy. Emotion. Because once emotion starts controlling your decisions, everything slowly begins to break. How it begins? It starts subtly. You take a loss. Now frustration appears. You take another trade too quickly. Then fear appears. You hesitate on the next setup. Then greed appears. You increase your risk trying to recover faster. And suddenly, you are no longer following a system. You are reacting emotionally to every outcome. Why it's so dangerous? The reason this is so dangerous is because emotional trading rarely feels emotional in the moment. It feels justified. You tell yourself, this setup looks strong. I'll just move the stop once. I can make it back quickly. And little by little, your discipline disappears without you noticing. The account death spiral. This creates a spiral. You lose confidence, so you force trades. Then losses increase. Now pressure increases too, and pressure changes behavior. You become impatient, reactive, desperate. That's how accounts collapse, not from one decision, but from emotional accumulation. Legendary trader Jesse Livermore experienced this cycle himself. He understood that markets punish emotional instability faster than bad analysis. Why most traders never see it? Most traders never recognize the real problem because they stay focused on strategy, indicators, entries. But the issue is deeper. As trading psychology expert Mark Douglas taught, consistency in trading comes from consistent thinking, and emotional thinking is never consistent. That's why traders can perform well one week, then completely collapse the next. The most dangerous moment in trading is not after a loss. It's after emotion enters unnoticed, because once emotion controls your decisions, you stop evaluating objectively. Now, losses feel personal, profits create overconfidence, patience disappears, and every decision becomes distorted. What professional traders understand? Professional traders understand something most beginners don't. The goal is not to avoid emotion. The goal is to prevent emotion from making decisions. That's why professionals reduce risk under stress, stop trading when emotional, focus on process over money, because they know emotional decisions compound quickly. The shift that saves accounts. If you want to protect your account, you need to start observing your emotional state like a chart. Pay attention to frustration, urgency, revenge impulses, fear after losses, because awareness interrupts the cycle. And once awareness appears, control can return. Closing. The silent killer of every trading account is not the market. It's emotional decision-making left unchecked. That's what slowly destroys consistency. And consistency is where survival lives. Subscribe to Mind Over Markets. Because in trading, the biggest enemy is rarely the chart. It's the emotion behind the click.